Hi, I'm Bill Story of the Olderhood Group, and welcome to Not the Retirement Show. My guest today is Ian Price, who is a financial consultant based in the UK. Hi, Ian, how you doing?
I'm really well, thank you. It's nice to see you. Our first one of the new year, so it's good, isn't it?
Exactly, 2023. My goodness me, seems it seems to be going faster than ever, sort of thing. So,
Absolutely right.
I was thinking, Ian, today, we hear about people talking more and more, I guess, about taking early retirement. And over and above the sort of concept of, well, what are you going to do? If you retire at age 50, what are you going to do for the rest of your life? You could live another 20, 30, 40 years. But I think obviously one of the big things, biggest considerations really is the financial aspect of things, money and whatever. So leaving aside the pension fund, if you have a pension fund in your employment, etc., and how is that invested, leaving that aside for a moment, Ian, tell us a little bit about how to handle mutual fund strategy. And I want to just concentrate on mutual funds because I think that's a fairly wide angle type of a type of investments. If you retire at age 50 or 55, whatever may be early retirement, how should folks be looking at their mutual fund strategy for their own investments?
Very timely, Bill. Since I spoke to you last, a couple of things have happened in my life that brings this more into fruition. I've just had notification that my state benefits are going to be paid this year. So I'm rocking and rolling because I'm working towards state pension. Also, if you look at, say, just the UK at the minute, what's been fascinating to see recently is the government getting very concerned by how many people are actually leaving the workforce in their 50s. And it's having an impact, and it could have a longer term financial impact on big business. So that aside, which is a fascinating discussion, the other thing I saw last night, which links into this, in the UK last night on television, Jon Snow, who's a famous broadcaster, has done 2 programs on how to live to 100. And he's been going around the world, seeing him being in America and Japan. Fascinating to see. So your question is far more relevant than perhaps people realize, because they don't think they're going to live to 100, but they might. So the strategy they've got to have, you and I are very clear about strategies. One, it has to be personal, absolutely personal. There's no one size fits all. I'm a passionate believer in that. But clearly, any funds you have, you want to really do 2 things in some way. One, try and get growth. I know it sounds interesting, Bill, but at the minute, the world markets are an interesting place, as you know. We've seen some movement in markets positively in the beginning of the year. So you want to see growth. And most people I know are trying to beat inflation, Bill, as a driving factor. At the minute, in certain jurisdictions, that becomes harder. In the UK, we've got double-digit inflation. So actually getting a fund to do that can be quite hard. But having a strategy about how long you want that fund to last for, and does that fund actually need to produce income, becomes very key in the decisions you need to make. Because if that fund is going to become, like I call an income producing asset, that has a different connotation to say maybe just in future investing for capital growth.
Yeah, I think that's an excellent point, because I think when we talk about how much money do you need for retirement, we typically are talking about the value of our pension fund if you're in employment, but as more so the personal investment, as you call it, obviously in the mutual fund, because having 100,000 in your mutual fund, may sound okay. However, if you do take early retirement, then your employment income is going to stop because you're not working anymore. So where are you going to get your income? So it's all very well to talk about value, and that's fine. But where are you going to get your income? So talk to us a wee bit more about that income producing type of mutual fund, because I think that's the key. It's not just has the value of the mutual fund gone up this year. Well, probably this year's a bad year, of course, but has the mutual fund gone up? So I put in 100,000, it's now 105,000 or 110,000, all fine and dandy. However, Tell us about the income side of that, the income producing side of the mutual fund.
I think, Bill, in a funny sort of way, you've highlighted what I think is a key issue. One is you might be, when you're working, accumulating. So the strategy you have is that the fund needs to grow with, let's say, for instance, dividends reinvested, because you don't need to take income. So the strategy is all about, let's try, be perfectly blunt, to create as big a fund as I can outside my pension with the risk I'm prepared to take. And we've spoken many times about risk. There's now things that risk-free. I think as you come to think about, am I retiring early, that fund strategy might not be the strategy you now need, because you're now looking to take some income from it. I've seen some clients, which I quite like, almost take the natural yield of that fund. So let's, for instance, your example of 100,000, doesn't matter if it's dollars, UK pounds, whatever. Let's say, for instance, that produces 10% yield. I know it'll be way outraged from it. Then actually, that's what they take. So what they don't take is more than the yield that the mutual fund is producing. So you might have a strategy with your investment to move towards more what you might call income producing assets. You know, around the world, Bill, you've been around a long time like me. There's some amazing companies that year on year give a good dividend. Johnson & Johnson springs to mind, believe it or not, British American Tobaccos, and they are well known for giving a good yield, you know, the dividend on that investment. So I think having that strategy is key. But it goes back to your starting point. If you stop work, what income is coming in before you make a decision on what you're going to do with your funds? Does that make sense, Bill? So very clearly, don't make a strategy, a decision until you say, right, I've now, let's say, take a figure. I need 50,000, doesn't matter, dollars, UK pounds to live off. What's coming in that I've already got from other assets? What does my mutual funds then need to give me to top up, in inverted commas, the income that I may need on a year-by-year basis?
I think that's, I mean, without any shadow of doubt, that's a critical issue, because I think, you know, you hear time and time again people talking about, well, you know, I'm thinking about taking retirement. I'll still use 100,000. You know, I've got 100,000 in investments, and you know, they're in a mutual fund and they're doing very well. But then you say, well, hold on, wait a minute. If you're going to take retirement, you're going to stop your regular monthly income. You get this sort of oh, gee, I never, yeah, right, well, whoa. So, you know, there's all sorts of types of variety of mutual fund. You know, there's equity mutual funds, fixed incomes, and so on and so forth. Is a fixed income type of mutual fund perhaps better for when you are in retirement, if you've taken early retirement, because it should be producing in some level of interest income, investment income, dividend income, if you prefer the word? Is that a better fund to be in?
I think, I'd love to have a crystal ball to say, oh yeah, I think what you need is, funny enough, is like almost like a portfolio effect. You know, Bill, you and I have spoken both on camera and off camera. The older we get, I believe people's attitude to risk diminishes because they get more risk averse. And that's why I'm passionate, as you get older, any decisions you make includes the next generation. So they're fully aware of what you're doing. So in other words, believe it or not, we're just about to have a review of my financial affairs with my advisor, with my lovely wife, Nicole, and my two daughters are coming along. One's 30, one's 34. They've both got lasting power of attorneys. They need to know. So you're absolutely right that fixed interest might be part of the solution. It might not be the whole solution. I think what people have got to really understand, Bill, and I know you've done this before, the more money you take out of the fund, the more you're likely to start eating into capital. If you're starting into keeping capital each year, that investment will have to work harder to stand still. So what I call understanding the yield and the, you know, what you can take out, the higher, you know, I've seen people say, right, I'm going to take out 10% out of fund. History will tell you that fund will erode over time. Unless you're in a speculative fund, you will start eating into capital and you might run out of money. Big warning, a bit like smoking. Smoking can kill you. You know, if you take too much, you could run out of money. That's not what you want. So you're right, deciding what asset class you want depends. Now, if you're young, and by the way, Bill, now everybody's young compared to me, as you know, but if you're in your 50s, moving to fixed interest sounds great. Hang on a second, you might have 40 years. Is fixed interest right then? I'm not convinced it is, because you need the equity returns, which is more likely to keep pace with inflation if history repeats itself in the market, in different world markets. So I think, as always, Bill, it's horses for courses, I'd say. Clearly have a, review what you've got. We're passionate, Bill, on a yearly basis. This is not a 5-year decision. It's a bit like me. Ian, this is 2023. What money do you need in 2023 for your family? Well, we're not having a wedding this year, so I don't need to worry about that. But next year we might have. I'm changing my car. I need to worry about. So does it make sense? But it's a very much a fluid thing, but all the time understanding the more money you take out of the fund, the more likely that fund's going to erode over time. And like you said, I'm popping down. Yet again, she's in my presentation to see my mum is 99 next month. I'm going down to see her on Saturday. Amazing. I saw my in-laws yesterday. They're 87. This is really real, this longevity issue.
So should you be trying to, and again, we're talking about the in-retirement phase, should you be trying to maintain the value of your mutual funds, or should you be going for growth? Because obviously another factor that comes into this, which perhaps confuses it, is leaving an estate, the inheritance issue. Because if you're going to take out more from your mutual fund by way of income for yourself, and thereby reducing the balance, the value of the mutual fund, then you're going to be leaving, less, by way of inheritance. But isn't the point really that you need to take care of yourself first, and therefore, you've got groceries or accommodation costs or whatever sort of thing. You need income because you have to replace your current employment income with something else. Leaving aside state pension, leaving aside, employment pension, you need to replace it with something else. So you must, presumably you want to maintain your style of life, you want to travel, whatever. So where do you go on the value? How do you maintain the value, or should you be trying to increase the value, or does it really matter if you get the income?
Well, I think what you can be, if you're not careful, you're trying to solve too many problems with one product. To me, the starting point has to be: have I got enough income to pay the bills? End of story. I've just experienced. This is the UK. My mum's in a lovely nursing home. They've just announced those are going up fees are going up by 10% this year. So that's another 10%, which is fine. She's got that. So I think my responsibility or response to that is anybody needs to protect themselves and their partner first from an income protection. It would be nice if the capital did not erode. Absolutely right. But in real terms, it's not like if you're trying to take income, you're not likely to be able to take income and keep capital growing. It's almost impossible. I'm sure somebody out there will go, yes, but if you invested in Amazon shares, you would have done, yeah, okay, forget it. We've said that story before. So in reality, a fund can only do so much. Investment managers can only do so much. So the chance of actually increasing capital growth and taking income, yeah, there might be times, but overall, if I started now with say 100,000 units of something, and by the way, so it's worth 100,000, should say, not units, 100,000. In 20 years' time, it's worth 100,000. That ain't bad if I take an income out of it as well. I think you've got to be realistic, and you can't make investments do so much without some degree of high risk strategy, which I then go back to you is the first thing to do is make sure you've got enough income to pay the bills. And as we're seeing at the minute around the world, we've got inflation at 10%. The older you are, the inflation's probably more because it just is. I've just had to put the heating on upstairs in the house. I don't usually do it, but it's very cold here, so I've had to do that. So you've got to balance that. So I think, Bill, to me, what is the key objective has to be start with number one. We need income. Point one. How do we get that income? Point two, how much of my mutual funds or funds do I need to access to make the top up between, let's say, my 50,000 and I've got 40 grand coming in, so I need to make 10 grand up each year. Then look at that and understand the consequences of the decision you're making.
Yeah, I think the point here is that there are trade-offs. Yes. You got to trade one thing against the other, And I think that's where hopefully the value of this type of advice, for our viewers is critically important, because it's not just a one idea concept of, I'll just put money into a mutual fund and I can take retirement. No, slow down. You got to think about this. So I think we've touched on the mutual funds, and I think in the next video, Ian, we'll look at perhaps maybe equities or something like that, and then we can maybe look at fixed income, and then we can probably bring them all back together again, because one is dependent on the other. But
absolutely right.
I think so. I mean, I think the closing point is take care of yourself. Make sure if you're going to take early retirement, fine. Where are you going to get the income? Because you're going to live for a long time. So
hopefully.
There you go.
Hopefully.
Hopefully, that's right. So my guest today has been Ian Price, who is a renowned financial consultant in the UK. And I'm Bill Story of the Alderhood Group. And we'll catch you next time. Take care, folks. Bye.
Thanks, Bill.